questions or fill in. Oh, a recording in progress. So I'm really here just to kind of add a little bit of clarity on the residential side. In many cases, as you jump into the commercial side, you might want to revisit your residential portfolio. You might be taking money out. I'm here to sort of add a little color and clarity, and happy to answer the questions towards the end of it. But James is kind of the star here about the meeting potatoes for us tonight with how to get started with all this. So take it away, man.
Awesome. Well, thank you. Thanks for the kind introduction, Paul and Hugo. So yeah, as they sort of both mentioned, my specialty is really on the commercial side of things. So my background in lending has always been within commercial. Previous to being a broker, I worked for a big five bank for about 15 years, and it was all in commercial lending. So in the broker space, I've got like you said, I like to think I've got a bit of an understanding as to what lenders can do and some of the different strategies from a financing standpoint. So what I might do, if it works for everybody, I'm just going to share a screen. I do have a PowerPoint. And what I'll do is I'll use that as a backdrop. We can sort of walk through it. Some of the slides we might focus on more than others, but at least it kind of gives us a bit of a backbone. Just going to set it up here. So can everyone see that okay?
Not yet, buddy. I might have to make you.
Oh, you might have to set me up on presenter mode, I think.
Yeah, I got to make you host.
Right. Okay, no problem. I'll let you do that if
1 sec.
if you don't mind.
Yeah, 1 sec, buddy. I gotta find
No
you.
problem.
There you go. Co-host. There you go. You got the powers.
Perfect. So hopefully everyone can see on the screen. It's the agenda.
Not yet. Got to hit share screen again.
Okay, no problem. Sorry. Again, technology.
No worries.
Let me just jump myself back here. And I'm going to hit share.
There we go. I think it's coming
Got
up,
it.
James.
Perfect. Thank you. Thanks, Paul. Appreciate that. So I'm just going to blow this up a little bit bigger here. Perfect. So as I mentioned, I'm just going to kind of use this as a bit of a backdrop as we walk through. And now, some of the questions that you might have as we go may actually get answered throughout the presentation. So just to make it a little more efficient and kind of make sure that we're better use of time, perhaps we can kind of answer some questions at the end. We can field whatever questions there are. As mentioned, we're going to kind of talk about some different strategies from a financing standpoint that are really commonplace in today's kind of financing landscape. We're going to focus on income properties, primarily on multi-unit. As Paul said, that's certainly a hot property, a hot asset these days, and lenders do like multi-unit. There's lots of demand for that from a lender standpoint. But we can certainly look at like if you've got mixed use properties, and I'll kind of touch on this as we go. There'll be some similarities from a financing strategy standpoint. So we're going to just, again, touch quickly on a few of the different lending requirements that come into play with commercial, and then ultimately why commercial. So some of the upside, we'll kind of go through that a little bit. We'll walk through a case study quickly just to give you an idea as to what it kind of looks like from a number standpoint. And then again, at the end, we can sort of field some questions. So just right off the top here. So obviously there's quite a wide range of commercial properties. And again, today we're going to sort of try to focus on the multifamily 5+ units. As you can see, there's a number of different asset types, and we're happy to help you out with any of those asset types. From a lender standpoint, I would say strongest appetite from a financing standpoint would definitely be for multi-unit and industrial. Industrial is a pretty hot asset these days as well. And then obviously you've got other properties like retail and office, which, are very much dependent on what tenants are in when it comes to those properties. And then, like I said, mixed use is another one, which we'll touch on a little bit as well. Okay, so kind of getting a little bit into the good stuff here. So I know it's a lot on the screen there, so I'll kind of speak to it as we go. So these are just some of the different strategies, and I don't want you to focus too much on the numbers that you see, because the one thing with commercial that I will say right off the top, it's very common sense lending. So, every property, every deal, it to some degree gets looked at on sort of a case by case basis. Okay, so there's a number of merits that get looked at. There's the property economics. There's going to be the borrower, there's going to be the location. So there's a number of factors that play into things like loan to value, things like what your max mortgageability number might be. So, and at the end of the day, there's ultimately three different buckets that we can look at when we're financing an income property. Okay. And I'm sure some of you are probably familiar with all three of these buckets and probably very well versed in them. But just to kind of walk through them high level. So you've got your bridge or your private option. Okay. And this is really popular for properties where, you want to pick up a property that's distressed, rents might be under market, there might be high vacancy, and there's significant upside, right? So this is a great opportunity, again, to pick up a property, possibly in 1 to 2 years, turn over some units, do what needs to be done to kind of add some value and cash flow to that property. And we absolutely have, there's certainly sort of a niche from a lender standpoint. There's some niche products that cater to that specifically. So I say 50 to 85% loan to value because it ultimately depends on the property. So you could have a property that's fully vacant and it's a hard time, it's obviously lenders are going to be a little bit more cautious with those properties. You could have a property that has 50% vacancy, has some cash flow, and we can usually find a way to push those up on a loan to value basis. And that's ultimately all, usually done through some pro forma rents. We look at what projected rents are going to be once units are turned over, as well as maybe what sort of work might need to go into the property itself. The nice thing with these products, with these mortgages, is there's usually no minimum DSC. So in other words, as long as we can make the argument that the property, like I said, has significant upside or has some upside, there's a few different ways lenders will look at it. So sometimes I'd give you an interest reserve. Okay. So effectively you're not out of pocket at all. So in other words, the actual interest itself sort of gets capped on the loan. In other cases, it could be interest only that you're paying out of pocket throughout the term of the loan. So they're typically shorter term loans, 12 or 24 months is pretty common. Again, just enough time for you to go in there, turn over some units, and then ultimately add whatever value needs to be added to put the long-term mortgage in place on the property. So I would say that's a really popular strategy that we see. Like I said, there's oftentimes distressed properties out there, which, can sometimes be, you can pick those up at a relatively reasonable cap rate. Because again, there needs to be some work and there needs to be some tenant turnover. So the second one, again, getting into sort of the longer term financing options, we've got conventional and CMHC. Okay. I'll talk about conventional first. CMHC is obviously the, sort of the hot topic, especially at the moment, but I'll talk quickly about conventional because I would say that's the most widely used in terms of long-term financing. Virtually all the lenders we work with will entertain conventional mortgages on an income property. And again, that's loan to value. That's going to range. Okay. That's going to really depend on what that debt service coverage looks like. Okay. So with commercial, there's ultimately, I would say, one key ratio that, really often dictates what that mortgage ceiling looks like. And that's debt service coverage. So that's what your, again, your annual net operating income over your annual principal and interest payments. Okay. Usually lenders want to see around 125 as the number. There are some lenders that will allow us to go a bit tighter and some that are a bit tighter themselves and require a slightly higher number. But 125 is sort of a rule of thumb. And so oftentimes based on that number, we sort of back ourselves into whatever that loan value looks like. Okay. So based on yeah, sorry.
Sorry to interrupt you.
No, by all means.
For those who may not be too familiar with commercial, may not know what debt coverage ratio is, right? So the way I describe debt coverage ratio to people is for every dollar of debt service, bank wants to see $1.25 in net operating income. Very simple. Just think about you're the bank saying, well, why the hell would I lend on this property? I need to make sure that this property can support the debt service. So I know the debt service is going to be X. So the net operating income, the income minus all the expenses has to be, I need to maybe making $1.25 or 25% more income than there is debt service coming in. That's the simplest way to kind of understand that. Hope that makes
sense. Yeah, no, I agree. And that's a great way to break it down, Paul. I would agree. That's a good way to look at it. And I'll sort of, when I walk through the case study, you'll see, a few things will jump out there. And again, that relate to how the bank calculates that net operating income. Okay. So again, they're going to look at your gross rents. They're going to look at all your actual expenses, but then they're also going to factor in things like, a provision for vacancy. So even if the property is not vacant, it could be fully leased. Banks want to usually have a small deduction, could be in the range of kind of 3 to 5%. It depends typically on what the vacancy is for that particular market, but they'll always deduct that from the gross rents. And then typically they're going to deduct a management fee as well. So even if you're managing the property yourself, banks are going to look at it from the lens that, if they had to, take over the property, or if someone was owning the property that wasn't self-managing it, what they want to account for a management fee, and that's usually around 3. Same thing can be 3 to 5%. But otherwise, they're going to look at your actual expenses. They're going to look at if there are any utility deductions that need to be taken. They're going to look at that. They're going to look at insurance, and they're going to look at property taxes. So those are kind of the big ones. And then that's going to generate your net operating income, which is ultimately, as Paul alluded to, there needs to be a bit of a cushion there, right? And so, part of that is the bank wants to account for any future, rate fluctuations down the road, but also they want to make sure that you have a bit of extra cash flow from the property. So if something was to come up and you needed to inject some capital into the property, some sort of investment, then they want to know, again, that the property has positive cash flow. So like I said, the key number with conventional mortgages is 125. That's, like I said, that's kind of the number that most lenders work from. And from a amortization standpoint, the typical amortization is 25 years. Okay. But I will say that of late, I've had some conversations, even just within the last, handful of weeks, that there are lenders that are now starting to consider 30-year AMs, and there's talk of even going a bit longer. And from a conventional standpoint, and the reason behind that is because they want to compete with CMHC. They know they're losing business conventionally to CMHC, and they know that that amortization makes, like, a longer amortization makes sense if it's a newer property, or a property that's been, fully renovated, and the economic life is, 50 years of the property. They know that, 30-year AM makes sense. So we do have some lenders that will consider 30-year AMs. As it is today, they will consider it. But I would say the general, across the board, 25 years is the most common AM from a conventional mortgage.
That's interesting that they'll
Mhm.
shift toward that. That's really good, actually.
Yeah, for sure. I had a lunch with a commercial lender last week, and they had said that, it's kind of something that they've had a lot of discussion internally. They're thinking about piloting it. And again, it won't necessarily apply to every property, but if the property warrants it, they're definitely, it's probably going to go that way. It might become more widely spread in, months ahead. And again, the big reason for that is they want to compete with CMHC. And they understand too that, with rates being kind of where they are now, that longer amortization makes a huge difference in, in what they can extend as far as the mortgage number goes and the loan to value. So they understand that as well. So
just another point for those who are new to commercial, and like, if you're seeing all these numbers here and your brain is hurting, don't feel bad. It's normal. When we get into a property example and we're running through the pro forma of a property, and you can see the net income, operating expenses, net operating income, the debt service, and the cash flow, and the DCR, this is all going to make sense to you. But understanding this, you're never going to understand the numbers. So you kind of have to stay with it on it.
Yeah, absolutely. At the end of the day too, we want to make today, we want you to walk away today with some good general knowledge, and obviously you're more than welcome to reach out to us at any point in time, and we can, kind of run through some specific scenarios. But again, this is just to sort of highlight these 3 financing sort of strategies are sort of the 3 primary ones, and they all apply in slightly different scenarios. So again, the conventional mortgage, it's perfect for a property where, you may not, necessarily hold that property indefinitely. You don't need to necessarily maximize on your loan to value, so you've got some money to put down. there's more flexibility with a conventional mortgage than there is with a CMHC mortgage, as I'll touch on. And like I said, it's the most commonly, sort of the most common product from a lender standpoint. So not all lenders will entertain CMHC. It's a bit more selective in terms of what lenders will entertain CMHC, whereas virtually all of our A lenders and our, any of our sort of banks or credit unions or other lenders that we work with that are out there, they all pretty much entertain conventional mortgages. So
I just want to touch on one more thing before we
yeah, for sure.
like just to summarize it, in your head here, we all want to end up, if you're buying a building, 6 units, 8 units, 10 units, 12 units, 20 units, that's probably our range realistically in our markets, or what individuals or me and a partner would be after, something in that range. We want to end up with, if we're going to keep the property long term, CMHC financing or a quality professional financing. Bridge financing, you got to understand, is short term. Where am I going to use that? Let's say I'm buying a 6-plex and it's a fantastic property, great location, great price, but like we run into very often, the rents suck. 4 out of the 6 tenants have been there for 12 years and they're paying, $700 a month in rent. Everybody and their sister has been through that scenario. And it's like, what do? We can get the tenants out. Yes, the seller will provide us 2 units with or vacant possession on 2 units, but we got to work on getting the other 3 vacant, and the other ones are okay, they're paying market rent. What do? Because if the conventional lender and CMHC are going to take your debt service and say, well, you're not making enough income, you cannot support the debt, which means you have to put more down payment. It doesn't make sense for most investors to put a huge down payment down. So we can use bridge financing for short term to do the heavy lifting ahead of time. Now, we might pay a little bit higher in interest in the short term, but that's not a big deal, because we want to recycle those units, get the units vacant, do renovations if we need to, get market rents in there, and then flip that bridge private financing into a conventional, into CMHC, and then we're holding for the long term. And at that point, we're essentially doing a refinance. You're able to extract equity too. So as we get further into the presentation, that'll make a lot more sense, but keep that back here, your noodle, as we go along.
Yeah, no, really, really good points there. Really good points there, Paul. So, again, the last bucket that we'll talk about here, the CMHC. Okay, so I should point out too, worth noting, like the conventional and the bridge, they both really apply to mixed use or any sort of a multi-unit 5+. Okay. So whereas CMHC is a little bit more specific to residential, they do allow for some element of commercial, but by and large, like there are some tight parameters that you have to fit within if you've got commercial. So if you had a large apartment, if you had a decent sized apartment with commercial on a main, it could potentially qualify for CMHC, but by and large, it's sort of geared towards multi-unit. Okay. And so kind of just running through quickly, that program, and then we can talk about it. And it's very similar to, I'm sure all of you have, at one point when you purchased your first home, or maybe you didn't, maybe you were lucky you had 20% down, but if you needed to get insurance, very likely would have been CMHC insurance. So it's the exact same corporation, Crown Corp, that they ultimately, want to subsidize or insure, I should say, larger scale residential properties. And that's effectively what they have. They have a program in place specifically for commercial size multi-unit residential property. So anything 5+ units. And so the few advantages we'll talk about with CMHC, first of all, higher loan to value. Okay, so and I'm going to kind of focus on the standard program. There are different programs within CMHC. Okay. There are a number of different programs, but for the purpose of this, without trying to make things too complicated, I'm going to sort of use the standard program, and then if need be, we can kind of expand on that. But the standard program allows for up to 85% loan to value. Okay. Now there is a program, MLI Select, which actually allows up to 95, but in order to qualify for that, there are a number of different sort of things that number of different boxes you have to check: energy efficiency, affordability, accessibility. Okay. So it doesn't necessarily fit every property, whereas virtually every, I want to say just about every income property out there that's multi-unit can potentially qualify for the standard program. Okay. And I do underline up to 85%. Because at the end of the day, it is still driven by, similar to the conventional mortgage program, it is still driven by that debt service coverage. Okay, so they do want to see a minimum debt service coverage. Okay, so again, they want to see a minimum of your net operating income over your annual principal and interest payments. And it varies slightly. So if you've got a 5 and 6 unit property, okay, they actually allow you to have a slightly smaller debt service coverage. So their guideline is 110 on that, which is great because it allows you to, again, you don't have to have that a cushion quite as much, as you do with, say, conventional or with a larger CMHC property. So 7+ units, it actually does jump up to 130, the debt service coverage. So those are, again, few things to keep in mind, because at the end of the day, what we've, especially lately, what we're seeing with the current rate environment is it's really that debt service coverage that tends to be driving that mortgage ceiling. Okay, so up to 85% loan to value. When we walk through the example, you'll see what I mean. It doesn't necessarily mean that if you were to walk in tomorrow and here's a rent roll and 85% loan to value, it doesn't necessarily mean that you will qualify for 85%. But just know that at the end of, you're very likely going to get a higher loan to value on CMHC than you will with conventional. And as hopefully rates, do come down, we're hoping to see that happen as the year progresses towards the end of the year and into next year. That will have a direct impact on that debt service coverage, which will conversely have a direct impact on that mortgageability number. So just kind of tying things together here. So if you were to, for example, if you were to have a bridge or private, for say a year, 2 years from, let's just say from today, then there's pretty good chance that the rates are going to be that lower. So not only are you kind of double ending it, so not only are you turning over some rents within that time period, but you're probably also going to qualify for a higher mortgage, whether it be conventional or CMHC, in a year's time. When you do that long-term takeout. So just again, a couple things to kind of keep in mind. The other big thing with CMHC, which is a huge plus, is the amortization. So they do allow up to 40-year AM, okay, which makes a big difference, especially when we're looking at that debt service coverage. So it kind of spreads that over 40 years versus say 25 years or even 30 years. So some of the other programs do kind of vary a bit. There is a program that allows up to 50 years, but again, there are certain, criteria that you need to meet in order to qualify. Which, granted, there are criteria for the regular CMHC program, but they're not as stringent as some of the other programs. So again, 40-year amortization is sort of the standard max. And, again, comes back to common sense lending. So they will look at what the economic life is of the property. So, I mean, if it's a really dated property and the appraisal comes back and the economic life's, 30 years, then they will typically scale back that amortization. But if it's a pretty decent property in pretty decent shape, or a new property or a property that's even older that you put, you've invested some capital into, then we can usually get ourselves to that 40-year. So, and then they offer terms of 5 or 10 years. So there's not quite the same flexibility there when it comes to the term options. So those are sort of the 2 term options. Based, I would say 5 years would certainly be the more common one that most folks go for. Versus the 10-year, because you're locked in for that period of the period of that term. It is a little bit harder to unwind to get out of a CMHC mortgage. So that's why I say if it's a property that you don't think you're going to hold indefinitely, you're probably better off with a conventional. Or even if it's a property you think, I'm going to turn this over and I'm going to flip it and kind of realizing some of that value, then the first option makes the most sense, the bridge. Okay, so that's like I said, that's kind of the high level of the 3 programs, and we'll kind of walk through, I'll kind of touch on as we go now, just some other points in general for commercial, some upside, some things to know. But that's sort of, like I said, the nuts and bolts of the 3 programs. So some key points to commercial. So I'm just going to put them all out here for start, and then we can just walk through. So down payment, again, 25, the rule of thumb, I would say if you're looking at it conventionally, you probably want to have about 35%. Okay. Because you want to expect that, again, based on, when the lender runs their numbers, what they're lending may not necessarily be that full 75% conventionally, or if it's CMHC, you can typically get a lower down payment. But I mean, I wouldn't recommend going into it thinking you're going to have 15% down payment. So rule of thumb, I would go into it thinking 25 to 35%. Okay, that's oftentimes the case. You know, and again, if it's a vacant, you know, highly vacant property, you can expect the down payment to probably, you know, be a little bit higher. And then net worth. So this is a big key point, okay, especially for any of you folks who have, you know, residential rental properties, right? As you probably know, you've gone through the process, you know, there's ratios that come into play, your personal income ratios. So you can throw those out the window, okay, for commercial, they don't apply, okay? So folks who, you know, again, can sometimes be maxed out with your personal income ratios, TDS and GDS are the names of those ratios. Neither ratio applies in commercial. Okay, so something to really, you know, really important thing to be aware of. So again, it comes back to common sense lending. You know, primarily lenders will look at the property itself, right? So they're going to look at the ratio that we talked about on the property itself. Okay, secondary to that, they're going to look at what does your liquidity look like outside of the property. And there's no magic number. It's just they want to know that you've got a net worth that makes sense relative to the property itself. You know, so if, for example, something was to happen, you needed to inject some money, there was, you know, some unforeseen, you know, vacancies, that they just want to know that you've got ability to kind of, you know, cover that. But there really isn't a, like I said, a magic number, and nor is there, you know, they're not worried about things like what are your, you know, your personal obligations for car loans or for credit cards or for lines of credit. They're not necessarily focused on that at all. It's really the property itself. So I do, you know, again, I stress that. Because that is certainly, you know, it opens up more options. If you've got some capital, you know, again, you kind of check the box on having the liquidity and the net worth met, and the down payment met, but you don't have to worry about what those income ratios look like so much. So, and, you know, will they ask for your, you know, probably for your last year's T1s and NOAs? Very likely they will. But again, they just want to sort of, again, common sense. They just want to make sure, is this individual paying their taxes? You know, do they have a job? Like, what's the situation, right? But they're not necessarily looking at it for any specific reason, really, other than that. Experience is a big one that commercial lenders do put emphasis on. So if you've got experience with, you know, residential rental properties, that certainly, you know, helps to check that box. But I mean, if you had no experience and you walked into a lender and you know, we put an application in front of a lender and you wanted to purchase, say, a 12-unit property and you've never owned an income property before, they may ask some questions. But that's where we can jump in and help kind of mitigate that, and as well as a professional, obviously a professional property manager really comes into play there as well. So those are a couple, you know, there are, like I said, they do put emphasis on experience, but there are ways to mitigate it. And then just a few of the other things to, again, be aware of as you know, let's say you are looking at a commercial property. So, you know, things like an appraisal, okay, and the designation is called AACI, so a commercial appraisal. In some cases, depending on the size and location of a property, okay, lenders may ask for a phase 1 ESA, okay, environmental site assessment. It's not uncommon at all. For those of you that have kind of, you know, stepped into the world of commercial, I'm sure you're aware of it and familiar with it, but it's one of those common requirements sometimes for commercial mortgages. And then the third one is just a building condition assessment, which does sometimes come into play on older properties. Some lenders will ask for that. So, which, you know, at the end of the day, you as a purchaser of that property probably will have interest in that as well. So I would say the one thing with all three of these reports, okay, which is a bit different, you know, it operates a bit differently in the residential world, in that, you know, let's say we're going through the process of the application. You can order the report, or we can work together to get that report ordered. It does not have to be ordered specifically by the lender. Okay, so you can get your eyes on that report, and then once we've got the report, they'll typically want a reliance letter so that they can rely on the report. But it isn't the case necessarily where the lender has to be the one to order the report. So, like I said, it's slightly different in that respect. And again, the last two reports, the phase 1 and the building condition assessment, they can sometimes be waived, okay, on smaller properties. So those 5 and 6 unit properties, oftentimes we can make a case to waive those. You know, you can expect an appraisal to be required virtually, you know, I would say 100% of the time. It's pretty common that they'll want an appraisal. So And then the last thing I would want to point out, just again, so everyone's aware, the commercial space is a little bit different in that, lenders typically do charge a lender fee, and that's just common. That's commonplace, regardless whether we walk into, it's a bank or it's a credit union or it's a B lender or, a bridge mortgage. There's typically going to be a lender fee and then a broker fee. Okay, so those are usually about 1% each. So just something to kind of factor into the overall, picture as you kind of, run your numbers and start to run analysis on any property. So, and those are both kind of one-time fees that kind of apply to the whole overall application process. So
James, on
yeah.
on a CMHC,
Yes.
sometimes we're not doing an appraisal; they're doing their own appraisal, correct?
Yeah, so on CMHC, that's a good point you bring that up. So what CMHC will often do is they'll do an internal valuation. So that's one little footnote, and you make a good point. So when we say 85% loan to value, the key to remember there is that's CMHC value that they're going off of. Okay, so they do. You're right. That's a great point. As part of their overall underwriting, and I think it's the next screen. Actually, we'll talk about the timeline for commercial mortgage approvals. But with CMHC, part of that process is they will do an internal valuation. They will, virtually look at it similar to how an appraiser would. And that, they're going to look at the income, the expenses, and they're going to look at it, they're going to use the cap rate that they're comfortable with. And you're exactly right. So they sort of do an internal appraisal. So will they typically ask for a third party appraisal? Yes. But they are often doing their own valuation as well internally. So
cool.
Yeah.
All right.
Awesome.
I guess the broker fee may or may not still be the same, but the lender fee may not be a percent with CMHC. It might be a fixed fee, correct?
Yeah. So with CMHC, and so I'm sort of generalizing it here, but with CMHC, they do have sort of their own set of, I guess you could say, specific fees. So there's an application fee which applies to the actual application. There's also, of course, the CMHC insurance. So that is their insurance premium, which you don't have to pay out of pocket. Okay, so that goes right on top of the balance of the mortgage. But it, again, very similar to, if you were to buy your own house, your personal house, personal property, and put down 5%, you've got that insurance that gets tacked on the mortgage. It operates very similar to that. So depending on a number of factors, sort of dictates what that insurance premium number looks like. But yeah, to your point, CMHC does have their own sort of set of application fees, which is really driven by the number of units.
Cool.
Yeah. All right. So approval time frame, and I think we kind of touched on that, but I'll just, I guess bring this up. So again, keep in mind the really what I want to stress here is that CMHC timeline, it is a bit longer. Okay. So just something you want to manage. So, I mean, if you've got a property that's closing in, 3 months, you just, CMHC would be extremely tight to try to get set up and funded within that time frame. So oftentimes, again, folks will, take that bridge approach, which we can typically get set up in 8 to 10 weeks. And again, those numbers can vary. Like, I don't want you to put too much stock into those time frames, because that's, again, it somewhat can depend on the property, what reports might be required, things of that nature. And sometimes it happens faster than that. So a bridge, oftentimes, or private, we may be able to get in place faster than 8 weeks. But like I said, for CMHC, keep in mind it is a longer timeline to kind of walk through that whole application process from start to finish. So
I thought you could do it in 5 business days. What are you talking about, James?
Yeah, exactly. Here's your, and if someone tells you that they can do it in 5, I would run the other direction very quickly. But yeah, again, it really fluctuates. I know when they had the MLI Select program out, sometimes things were at certain points in time taking longer. So it can oftentimes depend on what's, like I said, really their capacity and like I said, what reports and things are required. But at the end of the day, it's important to allow yourself some time for that process if you do want to go CMHC. Okay, so why commercial? So let's talk about some of the reasons to go commercial. I mean, we've just talked about all this, all these requirements. Let's talk about what the upside is. So first of all, scale up, right? There's no max number of units. So again, I know on the residential side, folks will run into that where certain lenders will have a max number of units that you can, that they will allow, and anything over that you sort of max out. Very similar to the TDS GDS ratio in some respects there. So in the commercial space, there is no max number of units. Okay, so you don't have to worry about that. And the other thing with scaling up, you could look at it that, again, there's some economies of scale with, let's say having a 12-unit property versus having, multiple duplexes, right? You in some ways it's easier to manage if it's one property, right? So you do get some economies of scale there. And I say less competition. So, yes, there's higher upfront capital, right? You're looking typically at a higher down payment. But because of that, you're probably looking at a little bit less competition for that property, right? Because not everyone can necessarily go in and put down 35% if they have to. So again, it's, type of thing, if you've got that capital and you might otherwise be running into issues either with the max number of units or, income ratios. That's where commercial is kind of a really good niche, a really good fit. And then common sense lending. I know I touched on it earlier, but I just put that in there, I guess, as well. And then, the ultimate, potential for a primary source of income. I mean, when you're getting into, when you start to scale up with commercial properties, I mean, it certainly, there are lots of developers, as everyone knows, lots of folks out there, they had to start somewhere. And, again, you could certainly scale up and get to the point where that could really be your primary source of income, owning and managing commercial properties. So
If I can jump in there, James.
Yeah, please.
I was taught this saying, early by some old guys with, many more properties than I have even today. And, they said, you don't buy multifamily to make money. You buy multifamily when you have money. Okay. So you don't buy multifamily to make money. You buy multifamily to have money. So these were some people who, I guess I would call them wealthy, but they've been, working hard in their businesses for 20, 30, 40 years and accumulated, a ton of money. And over a periods of time, they were just buying real estate. So they didn't have, ridiculous amounts of cash sitting around. They're by no stretch Elon Musk or anything, but, when they had money, they bought multifamily, and that multifamily preserved their wealth, and in their older age gave them a tremendous amount of income to go do, whatever it is that they wanted to do. And, now it's a little bit harder in today's day and age with the prices and the way things are and the whole environment, but the fundamental truth of that, I still think holds true. And if you're really looking to draw an income from your real estate, there's a really big difference between having 20 single family homes in a 20-unit building. I'm not here to tell you that one is better than the other. If you hear that, run the other way. Each of those strategies provides a different advantage and different disadvantages. The right answer is a little bit of both. You might have a bunch of single families and duplexes and triplexes and stuff that provide a little bit of cash flow or decent cash flow, but appreciate really well and are very liquid, very easy to refinance, very easy to move in and out of lending, refinance, sale, all that kind of stuff. No big penalties. Whereas the bigger, larger commercial multifamily that we're talking about now, that's still your long-term trophy properties. Those are the ones you put on the mantle and leave them there for 10, 15, 20 years to help pay down and then draw income from, if that makes any sense. So that's a big reason why commercial multifamily for me.
No, really, really good points. I would agree 100% with all of that. And you're right. Yeah, exactly to your point. The liquidity, in other words, like if you wanted to refinance or extract some equity, it's a little, it can be done with commercial, but obviously it's not necessarily the same as doing it if you've got, multiple, say, single family or duplexes, right? Going in and just refinancing one property. So something to obviously keep in mind. It's a good point, Paul. So what we're going to do here, and I thought for the sake of this, and there's lots of numbers, I'm just going to use, some round numbers. And these are all sort of in line with what you would probably see from an expenses standpoint. And I've erred on the side of caution, conserve, from a cash flow, things like that. But I just want to walk through the sort of, what lenders will look at. Okay. And like I said, kind of using some, conservative approaches to it as well. So you've got your gross rents. So for example, let's say we've got a property, gross rents are 200,000. Okay. And with that property, you've got expenses of 60,000. So 30% expense ratio. Okay. So again, there are some properties out there that are certainly run a bit leaner that will have more tighter expense ratios. But then there's also those properties that are going to have a higher expense ratio. So just kind of using 30% as a round number. And I think I did allude to it earlier, I believe, but things like vacancy management, repairs and maintenance. So even if those aren't showing on actual expenses for the previous year, let's say for that particular property, you can bank on lenders deducting those. Okay. Small amounts, mind you, but it could be 3% or 4% deductions for vacancy and management. And now repairs and maintenance, it's a little different. They'll sometimes deduct a number based on the number of doors. So it could be as simple as 750 per door is a common one that lenders use. So again, just things to keep in mind that those are often deducted, even if they weren't actual expenses. Okay. So in this example, we get our net operating income of 140. Okay, 140,000. So if that was a 5 cap, which is seems like a pretty good investment. If it's a 5 cap, 2.8 is sort of your give or take your number for value. Okay, so then when you really look at it from a conventional standpoint, if you were just to go, if you were just to go from a conventional standpoint, you're looking at give or take around 1.45. And again, this is conservative, so I'm using 125 DSC, a 6% rate. Okay. So right now, and that's obviously the $1 million question is what are rates currently? So right now, and we are seeing rates come off a bit. So that's the positive. But rates right now, anywhere around 6, in some cases higher than 6. In some cases, we can push it down slightly lower than 6. But for this example, we use 6%. Based on all of those factors, like I said, you're looking at a max mortgage, give or take, of about 145. Okay, and that's based on, really that's based on that debt serviceability number. Okay, because that's kind of what drives things. And then the second option here is your CMHC. So you can see in this example, right, the potential for CMHC, you could actually get about a little over 2 million for a mortgage number based on the cash flow. We're basing this on a DSC of 130, and I'm using a rate of 4.25 for that. Okay, and the reason that is because with CMHC, they base their rate off of bond yields. Okay. And typically, it's going to be, based on where bond yields are today, we're going to be around 4.25. Okay. And then again, I'm using a 40-year amp for this example. Okay. So you can see right there, you get a higher loan to value. Okay. And like I said, this is just sort of one example using sort of some, again, I don't want to, use numbers that are too aggressive, somewhat, but realistic at the same time, right? So you can kind of see how it all flows together. That's the key. You can see how you've got your, again, your net operating income ultimately driving your debt service coverage. Just to give you, like I said, sort of a bit of a rough idea as to what. And again, this could be a property where there's potential to up those gross rents, right? You could, those gross rents could be based on a couple units being under market rents. So if you were to up those rents, and let's say that gross rent number became 250, then everything increases kind of accordingly. So so that's just, like I said, kind of an illustration to walk through what it might look like. And there are other factors, important to keep in mind. There are other factors that kind of come into play, the property itself and things like that. So it's not all just a numbers driven, it's not all just a numbers game, but it at the end of the day, the numbers certainly, influence as to what that number looks like for a mortgage. So
I'm going to show you guys a real life example in a second, and it'll make a lot more sense. But this is a good a mini example here just to kind of prime your brains for it. Mm-hmm. So when someone like me is looking at this, and if we were analyzing this property, never mind how many units it is or where location or anything, just strictly looking at the numbers, I can already tell you that the rents are low, right? They're low for the market. Mm-hmm. Because if I have to tell Sal that, hey, Sal, you're going to buy this thing at 2.8 million and I need you to put $1.4 million down. Sal is going to tell me you're crazy, right? Doesn't make sense for the marketplace. No one's going to put 50% down on a property like that. Now the CMHC option looks a hell of a lot better, you know, with a 40-year AM and a 4.25 interest rate. So, you know, looking at this, there's going to be, when we're looking at this, we were looking at it holistically. We're like, okay, if we go conventional, it's this. Maybe it's a crappy option, maybe it's not, but here's what we have on our plate. If we go CMHC, it's this, and that looks a hell of a lot better. On a $2.8 million building, if you're putting, you know, 750, 800 million bucks down, that's pretty realistic. You're in the 30% range there. That's actually very, very fair. Okay, very, very fair. Or if we recognize that, you know, maybe 30, 40% of the units are really under market value, and we can negotiate some of the units to be vacant on closing, it might make sense to take a 1-year bridge, right? Get the rest of the units vacant, renovate them, clean them up, whatever we have to do, you know, get all the rents up closer to market, and then go back to James and say, hey, look at our gross income now. It went from 200 to 260. Now what's CMHC going to give us? Because if we increase income, guess what happens? CMHC is going to go, well, we're using the same ratios. We're just going to give you more debt. And you're able to refinance back, pull back some of the equity you used to buy the property, pull back some of the equity you used to renovate. And that's how this game works. The more in commercial, the value you drive into the property is dictated by the income. The more you can drive up the income, the faster your value goes up. It's really forced value all the way. So James, if you don't mind, I just want to show people go through.
For sure, please do. Yeah, absolutely. And you make a really good point, and I'll jump off your, but you make a good point. So I mean, for example, the bridge option with this scenario, you know, again, there's no, you know, again, we don't have that minimum debt service coverage. So there's a good chance we could probably get a bridge that would effectively cover that same CMHC loan number, right? So you're not putting as much down at the outset. Something to keep in mind there.
Okay, so I'm going to bring it all together here. Now, some good questions that I'll touch on, you know, especially from Kevin. Where are we buying these type of multifamily properties? So typically, you know, if we're using Toronto as a center, we're not really buying anything in Toronto. You know, nothing's going to cash flow, and cap rates in Toronto are 3-4% if you're lucky, right? That means returns suck. Now, do people still buy them? Hell yes, they do, because there's some of those people that have, they're buying, they're not buying to make money, they're buying because they have money, and they just want what they consider to be the highest quality asset they can get, and they're not worried about cash flows because they might be putting 50, 60, 100% down. They're like, screw it, I have the cash, just give me the asset, I don't really care. Those are the kind of people that buy in the city of Toronto. Or they might be doing a land deal, they want to capture this land and assemble, that kind of stuff. We're not there. We're looking for income. So we're in secondary and even tertiary markets. So what's a secondary market? It's basically the GTA. So all the way around. Okay, Barrie, Kitchener-Waterloo, Cambridge, Hamilton, Brantford, Niagara region, St. Catherine. This one happens to be in Welland. Okay, Niagara Falls, East, you know, Oshawa, some of these places. Even we've gone even as far as Belleville. Further than that, we haven't gone. That's, you know, really too far in my opinion. It's too far for us to service properly. You're going to need local property managers, maybe even a local mortgage broker out there. I don't know. We can ask James if he can handle that stuff. But then those are our typical markets. And in these markets, what's important to realize is, yes, the rents are lower than, say, Toronto, but they might only be 10 or 15 or 20% lower. But what's interesting is the price is sometimes 50% lower, 60% lower, 40% lower. So the rent to price ratio is much, much higher in these secondary and tertiary markets, which is why we're able to create cash flow, right? Go find me a 7-unit building in Toronto and tell me what the price is. There's nothing less than $2 million, $2.5 million. Okay, you're talking 250, 300,000 or more per unit, you know, and here we're less than 200,000 a unit. Okay, you're not going to find these kind of prices out there, you know. And are you sacrificing, you know, location? You know, you could argue yes, But, we would argue that over the last decade, 15 years that we've been in this game, that these second and tertiary markets are growing rapidly with I'm sick of saying it, but we all know at this point that the amount of population growth we're getting is absolute insanity. 2022, they just came out with the numbers. We had 985,000 people come to Canada. Right? That's bonkers. So these secondary and tertiary markets are growing tremendously, and there's a tremendous need and demand for multifamily that is not being met by the marketplace, because you can't. It just is not enough, and we're growing at more than we can kind of supply. So this is why we target these certain areas. Okay, so just to give you an example, this is a 7-unit building in Welland. Just tied it up actually with a client. Gross rental, $85,000 a year. Okay, and you can see the breakdown here. 2-bedroom, $1,350. 1-bedroom. Okay, there's some of the rents I'm talking about. $568. This unit, I don't even have to see it. I can tell you it's a mess just by the rent. You know what I mean? This is very likely a gut job, right? $782, maybe slightly less than a gut job. $728. You know what I'm talking about? Like, these units are going to need work. And these are probably closer to market, $1,200, $1,230, $1,300. That's pretty close to market. And you can see we've done the math and the research to see the market rent potential if it's vacant today. $1,450, $1,300, $1,450. Okay, now look down at the bottom. It's producing a decent rent for what it is, at $7,150. But at full market rents, you're talking over $2,000 a month. So my question to you is, if this property cash flows today at a 5, 5.5, even a 6% interest rate, how good is the cash flow going to be when you turn over these units and get it up another $2,000 or $2,500 a month? That's a substantial income. And this is why multifamily is powerful. Okay. Now, we have tenant pays hydro. Oh, nice. Tenant pays hydro and gas in these units, which is great. And there's some notes here. We're not too worried about that. Okay. But this is if you're going to get into multifamily, you're going to have to get used to these cash flow statements and operating statements. This is a standard one that we created that we use. I'm just going to mute wherever that is. Sorry. There we go. Okay. So what we got here, the current rents, $71.51, $85.12 a year. We put that up here. We got a bit of storage income coming in, $480 a year. If there was coin laundry or something at the property, we would put that here. We might factor in parking income if it has it. So there's a lot of place to sort of add little bits of income. And it really does make a difference when you can add a couple thousand a year here and there. Okay. We want to put in a vacancy rate. And even though the property is obviously fully occupied, the vacancy rate is an average, because you'd be foolish to think that you're never going to have a vacancy. And vacancies tend to come in waves, I find, at least. I don't know. I have no science to prove this, but it seems like when there's one, there's 2 more coming. And sometimes it's a good thing. So you might go 2 years with 0 vacancy, and then the next year, you might have 10, So we want to average it out on an annual basis regardless. So what we do, very simply, take our gross rental income, we add in all our extras, okay, we get a gross operating income, and we subtract our vacancy, and we get what's called effective gross income. That's our 100% number. Okay, now we got to pay the bills. All right, so property taxes, okay, insurance. To me, the insurance looks probably a touch low here, right? We know the heat, hydro, gas and hydro is being paid by the tenants, so that's fantastic. Water bill for the building is great. Maintenance at $1,800, probably light, right? On a building with some units that haven't been touched in a long time, you can probably expect to spend a little bit more than $1,800 a year on maintenance. Stuff's going to break. You're going to have to cut the grass and shovel the snow, clear the parking lot. There's going to be stuff to do. So, I mean, if you were just to rough it out, a good number, I think James said it earlier, somewhere between $500 to $700 per unit per year. So if you had 7 units here, you could say 500 times 7 is $3,500 a year. 700 times 7, $4,900 a year, somewhere in that range. Okay. And then property management, we just have averaged out at 7%. You know, you might get it for 6, but whatever, something in there. And some people might manage the properties on their own. I have, I don't even know, 15 or 16 different rental properties. And some we manage our own, and stuff that's too far, you know, we have property management. So this is sort of a floating expense. But just a note on property management is that, you know, you're paying for it whether you like it or not. You're either paying with dollars or you're paying with time and pain in your ass. You can't escape. So just know that, oh, the property cash flow doesn't look good because I have to pay for property management. Well, you just got to value your time or your dollar, one or the other. Okay, cannot escape. So I don't want to hear that one. We got our gross income, we subtract our operating expenses, and then we have our NOI. This is a very important number for us as investors, but also for lenders. Okay, the lender is going to go through their own calculation to calculate the NOI. They might say, oh, this guy thinks he's going to maintain the property for $1,800 a year. No, we're going to make that, you know, $5,000 or $4,000 or whatever. And they're going to come up with their own operating expenses. They're going to stabilize it. I think that's a term they use. And then they're going to come up with their own NOI. Okay, we want to know what the NOI is too. Why? Because let's say 20 years from now, you pay off this mortgage. Well, guess what your cash flow is? $63,000. Assuming the rents and income hasn't changed at all, but obviously that's not realistic. But you know, if there's no mortgage on this property, you got a salary of, you know, just over 5 G's a month. Something we have to know. Okay, and we'll get into cap rate in a second. So we're able to tie this property up for $1,170,000, or just about $167,000 a unit, which is dirt cheap. Now, if you're don't understand, or I shouldn't say don't understand, but if you're not familiar with using the per unit pricing, think about a duplex. You know, a duplex in Kitchener. What's that going to sell for? 600, 700, 800, 900,000. Well, if you were doing a, you know, per unit price on an $800,000 duplex, which I don't think is a stretch, that's $400,000 a unit. Even if it was a $700,000 duplex, that's $350,000 a unit. And here we're buying 7 units for $167,000 a unit. Okay, this is the kind of efficiency you can't always get with smaller multifamily properties. Okay, this is why it's important. So just saying bye to Josh here. So, you know, right away, and we don't have, you know, an official quote from James yet. James is going to work overtime tonight and get us a quote, right? And, you know, we kind of estimated that we're going to need at least 35% down. And hey, if we need less, we need less. Great. But, you know, I think 35% likely would do it. Right. And we might do a bridge, we might not. We'll get into those options in a second. But just estimating at 65% loan to value, which means 35% down payment, it gives us a mortgage of about $760, a 25-year amortization, a 5-year term, and we've got a 5% interest rate there. Okay, you can see the monthly payment and the annual payment. Right now, we're going to get into DCR in a second. Before we get there, you know, if we put 35% down here, we're talking a down payment of about $440,000. That includes closing costs. Now, you know, you probably want to have another 20, 30, 40, 50 grand set aside for some minor renovations and just to absorb, you know, whatever's coming your way. Because if during negotiation, you know, we asked the seller to give us unit 2, 3, and 4 vacant, I'm going to do a money dance for you because that's fantastic. That means you're going to have to go spend some more money, you know, cleaning them up and renovating them, right? So you're going to want to have some cash aside. Okay, so these kind of investments are very profitable, but they can be capital intensive, especially in the beginning. Okay, but the refi afterward, you're going to be doing your own money dance, right? That's what we want to get to. Okay, so here's our debt coverage ratio. If we have an NOI, a net operating income, remember, income, a gross income minus our expenses gives us an NOI. If we have an NOI of 63,000 and our annual debt service is 53,000, that gives us a coverage ratio, a debt coverage ratio of 1.19, right? That's what we were talking about earlier. For every dollar of debt service, I have $1.19 of net operating income. That's it. That's all it is. That's what the lender wants to see. This guy or gal has $1.20 for every dollar of debt service he has to pay. He has a cushion. That's all they want to know. Okay, that's all they want to know. Right? And you know, if these calculations are correct, leaves you about 10 grand a year, and you know, gives you a little bit of a return. Now, your cash on cash return kind of sucks because the property is not stabilized. But as is, you get a monthly cash flow of $826, right? And a cap rate of 5.5, which for our marketplace is very good. Okay, very good. Now, I'll touch on a couple more things, but just to finish off the spreadsheet, you know, every year, remember, we're paying down the mortgage, right? And you're not paying it down, the tenants are paying it down by you collecting rent, right? So we get a return, you know, on that income, on that pay down. That's giving you about 4% a year. Appreciation, we have it set at 5, which is generous. Sometimes I use 2 or 3, even, to be honest, to be super, super conservative. You know, that's giving us about 15% a year, right? And with our cash on cash, we're getting about 20, 21% a year. Okay, now, here's the real fun. If you can take over this property, even as is, and you know, make 500, 800 bucks a month, that's not a fantastic investment. You know, that doesn't excite me. I wouldn't buy it. But if I can get unit 2, 3, and 4 vacant, and you know, spend, you know, maybe it's going to cost me 20, 25,000 a unit, to be fair, but get these kind of rents and increase the income, you know, from 85 to 114, what's that? Almost 30 grand a year. That's going to allow me to refinance the property. And when I refinance the property, I'll be able to recover not only the money I put in to renovate these units, but very likely some of my down payment also. Not all of it. Let's be realistic, not all of it, but some of the down payment also, while still having a healthy cash flow. And once I recover my money, that allows me to go and sit on my money, buy a boat, buy a car, do whatever I got to do, or look at other investments. Okay. And then I take this property, this 7-unit property, and I put it on the trophy shelf. I don't touch this anymore. It's done. It's we've got CMHC financing now. It's cash flowing well. I got a big chunk of my money back. Call me in 5 years when I'm ready to refinance again. And if in 5 years I recover all my capital back, now it's free. And I think for any long-term investor, that's where you want to end up, is to recover all your capital, keep it on the shelf, still cash flow, but have all your money back in your pocket. So for you to go buy more investments, that would make me happy and James happy, but also live your life. You know, go on vacation, go to Europe, go to the Caribbean, go do what you got to do, right? Make your family happy, whatever it is that kind of floats your boat, right? And this is real. Like, we just literally tied this up the other day. So if you're in the market for multifamily, commercial multifamily, you know, and you have that $300,000, $400,000, $500,000 kind of down payment, this is, I'm not saying you have to go to Welland and buy the exact same type of property, but this is the type of numbers where you're going to land. And if this scenario, you're like, I don't like it, doesn't work for me, I don't want to deal with tenants and renovation and stuff like that, totally fair. At least you know. At least you know. The better step would probably be to baby step it and go after something that's duplex, triplex, fourplex first before you jump into something like this. But the main reason why I think this has been such a popular topic is because a lot of people might want to do that, but we're being handcuffed, and me included, because of where rates are right now and the financing environment. It's not making it very easy to go and get financing and just go buy whatever triplex I want. So we're having to get creative with our money and make it work so it doesn't get destroyed by inflation. Okay, that's a big message here, is that if you're sitting on cash, you're stuck between a rock and a hard place. It's not my fault. I'm just a messenger here. Like, if you're sitting on the cash, it's getting eaten alive by inflation. Okay, that's just the reality of what it is. So you're going to have to put it to work somewhere, somehow. And if residential financing isn't going to work, then something like this is a very, very good bet. You may have to learn a new skill and how to deal with property managers, or it may be scary at first, yes. And if you've done stuff like this before, like Tanjeet and I were joking about, and this is, might be music to his ear, right? So I just wanted to give you guys a good picture of what's happening kind of in the real world here and what you should expect in terms of numbers. Does that make sense to everybody? Oh, Ben asked, hey, Ben, what's the cap rate used for? So a cap rate, okay. I know this is not going to be a super professional explanation, but I'll try and make it as dead simple as possible. So Ben, all you do is take where are we here? You take the net operating income and you divide it by the purchase price. That's it. To make it simple, take 63,000 divided by 1,170,000. That's going to give you 5.4, 5.5%. What the cap rate, it's short for capitalization rate. Just a fancy word that says this is the ratio between the net income and the purchase price. The higher the ratio, the more income I have in comparison to purchase price. The lower the ratio, remember I said cap rates in Toronto are low. That's because prices are so high. This means we're getting less income for every dollar of purchase price. Just a ratio to compare pricing, that's all. Okay, not a make or break type of thing.
Hey, Paul, I saw a good question here a little further back about vendor takebacks, because as the rates get higher, we're seeing a lot more creative type financing structures. So I don't know if maybe James wants to just comment on vendor takebacks, how lenders accept those. I think the question was also, can you do like no money down?
We're in the question period now, so shoot them away.
Yeah.
For sure, absolutely, I agree. No, and I did see that too. That's a great question, and the simple answer is yes. Lenders are open to vendor take-back mortgages in play. There's a few things to keep in mind. Typically, that vendor takebacks is going to need to postpone to the lender. So lenders are always going to want to be in first position. So as long as that VTB postpones to second position, okay. The second thing is that lenders do still want to see some skin in the game. Okay, the rule of thumb is about 10% as a minimum. So they usually want to leave got at least 10% skin in the game. So to answer the question, can you sort of max it out with a full VTB and then the rest, kind of borrowed money? Lenders don't love that. And again, it's one of those things where they do sort of look at it on a case by case basis for sure. But yes, vendor takebacks are generally permitted. And they are often used, especially in the case where, it's a property. And oftentimes vendor takebacks are short term, right? So if it's a property, again, where you may have a partial bridge mortgage, you may have a vendor takeback in play, and it may be a 2-year VTB. And then, once you realize that some of that increased value, we can increase the mortgage number for you, the increased cash flow, then you can pay out that VTB. Okay. So, again, to answer the question, in some cases, yes, it is certainly permitted.
There's a spot here to add your secondary mortgage or VTB. And if someone doesn't know what a VTB is, that's just simply a vendor take back mortgage. So, back to James's previous example, if you're buying a building for 2.8 million and the best mortgage you're going to get is 1.4 million, and Sal's got to put $1.4 million down, he might go to the seller and say, hey, will you hold a $700,000 mortgage for me? So I only have to put down 700 grand and I'll get a first mortgage for 1.4 and a second mortgage of $700,000 from the seller. And that's an easy way to, you could use a VTB as kind of a partial bridge mortgage to help you kind of move your way through, and it just greases the wheels to get deals done when the financing landscape may not be as cooperative as we want it to be.
For sure. Yeah, especially if you've ever got a motivated seller on a property, and so oftentimes they'll allow for that.
But I see the question here. No money down. Yeah. No money down is not going to happen with commercial unless like you go buy this building for 1.17 and you go directly to the seller and say, hey, can you hold a 100% VTB? Then it's available. Who's going to do that for you? I have no idea. I haven't met a person who will. I know there are people doing it, but they're very often in like out of the way markets. And I'm not saying that's good or bad. I'm just in my experience, that's where they are. In the core here is super, super rare.
Yeah. And I come across it once in a while too with really unique businesses. So like if someone's got a really unique business that they've been trying to unload for quite a while, they might be open to a really high VTB. But yeah, for typical income properties, again, you usually have to kind of stack it similar to what Paul just said. Usually you've got to have some money in.
Question from Mike Piazza. What a great name. Do you have more money down if you're making a deal with CMHC? I'm not sure I understand the question totally, Mike, what you're trying to ask. If you clarify a bit, I'm happy to get to it. Kevin, yeah, if you shoot me an email, Kev, I'll share the spreadsheet with you, no problem. Tanjeet saying this is very similar to a Niagara 5. Yeah, you know what? That's right. This kind of property that I'm showing you right now is very similar to a property, a 5-plex we did for Tanjeet in Niagara Falls. Similar kind of starting numbers with very similar potential to turn over the rents. And we actually did a video. This is not staged, by the way, just so you know. We did a video about Tanjeet and the property and all the numbers he kind of achieved. I'll send it off to you guys when we send the recording so you can kind of follow that story. But shoot me an email, Kev, I'll get that to you. So Johnny Q saying, if the rents raise to 114K, the cap rate is almost 8%. Bingo, you got it. You got it. That's exactly how it works. Yes, if you raise the rents, your cap rate increases. And that's how you're able to refinance. Because if the market cap is 5 or 5.5, you can refinance down and extract that equity back out for yourself. Okay, that's exactly right. Elliot, where are you finding these properties? As this one, for example, was last on the market in 2017. Elliot, these are available. You just got to have a good realtor. I don't tell you. Yeah, this one's off MLS. That's a good point, though. We do I would say out of for every 10 commercial multifamilies that we do, probably 3 to 5 come off market. So, we have pretty good relationships with people, and we don't have all the relationships, and we don't see all the off market, buildings that come through. That's not realistic either, but we do see quite a bit. We have relationships with property managers, other investors in our network. If John's going to sell one of his buildings, he might say, hey, Paul, I'm going to sell this thing and give a buyer. Here's the numbers. Another one of James's clients might be selling a building, and he might give James permission to share it within his network, and he might call me and say, hey, Paul, I got this guy, he wants to sell his 10 unit in Barrie. Here's the pro forma, he's allowed me to share it with you. So that stuff, a lot of that stuff comes off market fairly often. Okay, I see Hugo, you jumped in there. Thank you. From Ben, how do you know? Oh, we talked about that. How do you know the cap rates from different areas? Well, you kind of have to be in the game a little bit, Ben. CMHC does publish data that gives average cap rates for certain regions, in the country, either by city or by region. so you can pay attention to their data. I mean, I don't look at it too often, just we're in the game, so we kind of know, you know, what things are going to sell for, and what they should and what they shouldn't. Okay. No problem. Any other questions here? So if there's no other questions, I'll just quickly let you know that we're going to share the contact information for James and Hugo when we email you the recording for this presentation. You know, if you're interested in commercial multifamily, I would definitely suggest having a conversation with them to start with first. You know, of course, we can chat anytime you want, but sometimes understanding the financing and getting comfortable with who's going to help you with the financing kind of greases the wheels and helps you feel better about, you know, where it's going to go. And they can give you some, you know, pointers and help on how much capital you need, or with the capital you have, how much property or building can I get? You know, they might recommend you to go back to residential, who knows, but that's a good start. So we'll share their email and contact information. And
Yeah, Paul, if I can just jump in, I mean, just a typical journey. I work a lot with clients on the residential side who may have one rental or maybe 5 or 10 rentals, and they generally want to get into multi just for the reasons you said. They want something that's long-term, like a legacy piece for their family. You know, generally it's rare, and maybe you can comment on this, where someone just says, my first rental property is a commercial. Like, that doesn't normally happen very much because it's usually a little bit more involved, but it can happen. So usually the journey is they've got a couple properties and they're finding that there just isn't a lack of cash flowing properties, or more likely is they just don't qualify for traditional lending. Maybe they've gone self-employed, maybe they are no longer making a traditional salary, and the financing options that they do have access to just aren't attractive anymore. So we say, listen, commercial, like, you know, James made a good point, is going to allow you to qualify based on the financials of the property, not necessarily on your own personal employment income. So I think a lot of people are sometimes surprised in how much they can actually get in terms of financing. So I always recommend, you know, do kind of a review, you know, before you kind of get into that world. Let's do reviews, see what you have going on. We can show you where you can unlock capital, and then kind of, you know, have a conversation with Paul, James, and the team about what types of commercial that's are out there. So, you know, I think just get started, because a lot of times you'll be surprised as to what you can do. A lot of times people say, you know, well, how did you get 5 properties or 10 properties? And sometimes it's just, you know, I've seen it for years. It's just slow, you know, a little addiction. It's a little move, you know, how you to get to a position where you're now, you know, got a really healthy rental portfolio. So everyone's got to start somewhere. So.
exactly. So we'll wrap it up. A lot of familiar faces here. So you guys are probably already connected with what we do here. But for those who aren't, I'll just share that, you know, we publish a weekly newsletter, very, very popular. You know, we get thank you emails after the newsletter. I don't know why people like it so much, but apparently we're doing a good job. So if you want to get our newsletter, you can jump on there. Just go to our website here. And if you're brave enough to, you know, get this URL, you can automatically subscribe. I'm supposed to share that with you. You know, if you jump on our YouTube, you know, we're doing videos very often, you know, and no nonsense stuff. We really pick on news articles and we'll give our insight about them. That's really our shtick. We like to just keep a pulse on the marketplace and let you know kind of what's going on. Our last video we did was just about the recent LTB rule changes that kind of came in at the end of last week. If you didn't hear about those, jump on YouTube and subscribe, and, you know, we'll talk about those. You know, if you like Instagram, we'll try and make you laugh on Instagram. You know, don't yell at me if we're not politically correct, because we're definitely not. So, and what else we got? For this presentation only, you know, we're especially for those, if we know you already and we haven't spoken to you a while, you know, we're happy to kind of book a one-on-one session with you. You know, Josh and I, are one of my investment coaches, will sit down with you either by Zoom or in person here at the office, and we'll sit down and kind of get a real sense of your goals, where you are now, where you want to be in the future, and we'll figure out how to fill that gap. And, you know, commercial multifamily may or may not be a part of that, but we need to start somewhere. And if you don't start somewhere and figure out where you are now, you're never going to figure out where you want to go. So, you know, our mentoring and coaching piece we have is probably the foundation of our business. Without that, we would just be run-of-the-mill realtors trying to do deals every day, and that's not what we do. We really take, you know, passion in helping people and working with people for, you know, a decade, you know, or more. Some of the people on the call I've known for, you know, more than 10 years here, and I've been helping them for a long time and have gotten some tremendous results. So we want to work with you long-term and build a relationship. So you can head to our website there, and you know, /G form, and fill out the form with some basic information, and we'll contact you. I've been ordered to tell you that our website is migrating to a new hosting service. So if that doesn't work, we'll include this Google form link when we email you the recording. It's the same form. But I'm not a technical guy, but my technical people have made me tell you that today. So either way, we'll get you a link if you want to connect with us. And that's it. I see a couple more questions here. Thanks. Well, I appreciate it, guys. Thanks for being here. I hope we kind of answered all the right questions for you here. And if we did, you can pop an email back to us or connect with James and Hugo directly. So with that, we'll say goodnight.
Paul, if I could just really quickly add before we wrap
go.
up, I just want to say that, you know, as a team, we're a national team. We work with tons of different realtors, and you guys definitely stand out. Like, I love working with you guys because when we get the deal from you guys, it's already pre-vetted. You kind of understand the financing and what the lenders are looking for. So it makes our job a lot easier. So for everyone on this call, if you guys haven't already connected with these guys, like, these guys know their stuff. Super professional, but more importantly, they're very like straightforward. They're not going to BS you. They're not going to point you down a rabbit hole, and it makes our job easier, which means financing, you know, can be a lot more attractive as well. So, you know, just want to give you a big shout out there because you guys do an awesome job.
Oh, thanks, buddy. Appreciate it. Okay, well, let's say goodnight. You can maybe catch the end of the Leaf game here if anyone's even watching, and we'll hopefully see you guys in person or on Zoom real soon. Talk soon.
Thanks, everyone.
Ciao, ciao.